Let's talk oil prices at this point. The oil turmoil may be seeing some signs of relief, with NYMEX crude extending its rally. Speculation that a slowdown in the US shale boom will reduce the oil supply glut that's driven prices to one of its lowest levels in 5.5 years. That is keeping the market somewhat hopeful, but with oil prices almost having halved in 2014, is it the bottom for oil? To discuss that, I have a very special panel. Mark Keenan of Societe Generale, Amrita Sen of Energy Aspects. Joining me on this discussion, David Lennox of Fat Profits. He'll be joining us in just a few moments. Amrita, Mark, I want to wish both of you a very happy new year and start with you, Amrita. We are, of course, at the start of 2015. I want to discuss what you're watching out for in terms of an outlook for prices. How low, how much of a correction are you expecting?
I think oil prices are going to stay at low levels for the first half of the year. Although current prices are definitely not justified by fundamentals, but the downward pressures would remain because sentiment remains very, very bearish. Ultimately, we expect H1 crude prices to be averaging around the $60 mark. And then second half of the year, towards the back end of the year, prices should rise back to $80 because ultimately the cost of production is still high. And to balance the market, we still need higher oil prices.
Mark, I want you to respond to that. Would you agree that you would continue to see oil prices at highs all of this year? What's the kind of outlook you're working with for this year in terms of oil prices?
Yes, good morning. We have a similar view. Certainly for the first half of this year, the path of least resistance for oil prices certainly appears, certainly from what we've seen so far, lower. The second half of the year, prices should start to recover a little bit. One of the things that's caught so many people a little bit by surprise this year, building on already the weakness that we saw at the end of last year following the OPEC 27th meeting that we know about, with some additional factors that were a little surprising, most notably Iraqi output at the highest levels since 1980, Russian output at record levels, and then also perhaps of a little bit more concern, inventories within the United States during the month of December having built only for the second time in the history of oil markets. Traditionally, the month of December is a period when inventories are reduced to minimize tax burdens for end-of-year accounting. And there was a huge build in inventory. The only other time that this happened was at the end of the financial crisis when most markets had many other things to worry about. Also, the potential relaxation of U.S. oil exports, specifically the ultralight condensate crude that is now, for many institutions, allowed to be exported, is also worrying. The Obama administration, I think, directly said that this would reduce the stress on producing companies within the United States insofar as they're able to now sell some of this condensate to Mexico, for example, that have expressed quite a strong interest in buying it. So that acts a little bit to reduce the stress in terms of the urgency of cutting back any potential shale output growth going forward, and that's what's paved the way for this move lower so far this year.
Okay, I'm being also joined by David Lennox. He's joining us live from our Sydney studios. David, appreciate your time this morning. I've started this conversation by asking both of our other panelists what they're watching out for in terms of an outlook for prices for 2015, David.
Well, look, we certainly think that a couple of key factors will still need to be watched very closely. And as your other guests were suggesting, we need to certainly look at the production output that's coming, from those producers already there, that is primarily the US and OPEC. And we have to just start to watch what is really happening inside these two, the US and OPEC, to see if they are going to start actually winding back production through 2015. And again, we certainly think towards the end of 2015, oil prices will be significantly higher than where we see them today.
Amrita, there's an interesting thought which is being put forward at this point by most of the experts we're speaking with, and they're saying that there isn't any real bottom that they're seeing, whether it is $40, whether it's $20. All bets are on. What are you watching for?
We've totally agree with that because I think this is like a falling knife. So it needs to be very dangerous to call the bottom. Because the last $20 hasn't been justified by fundamentals, this is a classic overshooting in the market, as we call it. So really, the price can go anywhere. It can definitely go in the 30s or the 20s as well. But again, the lower the prices go today, the higher they will be in a year's time.
Okay. Mark, we are talking, of course, a slightly long-term view, but let me come to you with a slightly shorter-term view in the next, the one quarter that's left in this fiscal year. Given all the geopolitical commentary that we're picking up at this point, are you expecting some sort of correction?
No. Prices will remain very volatile naturally, especially as prices move into relatively new territory, or certainly ranges that we haven't seen for many years. I think that to try and get a handle on a price bottom, which is obviously the most important thing, and certainly the thing that most of our clients are very keen to find out. It's perhaps prudent to widen the net a little bit in terms of indicators that might be helpful in trying to understand this. And one of the things that we look at that's been quite an accurate indicator so far in the price fall are things like option open interest. And when you look at the speed and the density of open interest in for example, put options, which are options that producers are typically invest in to protect further downside. When you look at the tenor and the strike at which these are established, you get some insight into what the producing community are thinking. And there's certainly, if we look at the Brent market, last month there was a slew of activity across the $40 strike, very large put options being invested in, and a little bit recently down towards the 35 level, but the majority is around 40. With respect to WTI, it's a more liquid options market, it's more speculated, and there's certainly a strong equivalent floor around $30 and some forays down to as low as $20. So that gives an idea of what the market's capable of. And some people, not perhaps so familiar with oil, a forecast is helpful, but what's more useful sometimes is what do we think it's ultimately capable of doing, and that does add some color. In addition to that, the market is essentially waiting for production growth to decline in the US, and that will certainly stabilize prices. In order to get an idea of how that's progressing, things like employment numbers within the specific sectors of the oil extraction areas within the United States will provide color there. At the moment, these numbers are still growing. They're a little bit lagged, but they're still on a firm uptrend. So there's no signs of any wage cuts or employment change in employment profiles. In addition, things like rig counts have been falling, but production per rig has been increasing. So we need to really see changes in that profile. And when we see that, then we can start, calling a floor with a little bit more confidence. But certainly at the moment, it looks like we're going to shunt down to the $30 to $40 range potentially in TI.
David, I want to bring up something that Mark just pointed out in terms of what the market is capable of when you're talking of a bottom for oil prices. Where are you placing your bets? $20, $40, how low do you think it can go?
Look, we certainly thought that it would certainly go through the $50 barrel level, and that's generally happened. We do think, and we think Mark is probably right, that the amount of production that we can see globally at the moment would tend to suggest that there is further downside to the oil price, and we could potentially see another probably $10 to $15 perhaps shed from that price before we really do start to see some activities from the production side to start really significantly shutting in production. So at this point in time, we'd suggest that in the first half of the year, yes, we will see very volatile oil prices and probably somewhat lower than where they are now. But we do think the mechanisms in the oil sector are in place that we'll be able to see that price recover very quickly through the second half of the year.
Amrita, I want to talk to you about supply data, the supply data that we're picking up from the US. That has been rather volatile, hasn't it? How much do you think, stockpile data from the US specifically is playing out, coming at a time really when demand is very weak? How much of an impact is that having as far as prices go at this point?
I think what's going on with gasoline and diesel is slightly different from crude because, and particularly that US number that you mentioned, because remember, this is the last week of the year. Demand is particularly weak, right? It's Christmas holidays, things are closed. And what happens in the US is that they have these special taxes, which incentivize refineries to get rid of their crude. So they really ran their refineries very, very hard, and they built a lot of gasoline and diesel stocks as a result of that. I don't think they're going to necessarily continue building at this pace, but yes, I think overall, globally, there is overcapacity in refining, and demand is picking up, but it's not going to be enough to absorb all of that.
David, I want you to come in on this and talk about how much of the pressure really that we're seeing right now in terms of how oil prices are panning out is being added because of the supply concerns. And do you think that once the supply issues, once the supply concerns are sorted out, we could see more rationality as far as prices go?
Oh, look, there's no doubt that the oil market is really no different to any other markets in that ultimately it does come down to those demand and supply factors that either produce more or produce less, or demand more or demand less. We are seeing a very weak price period at the moment, and of course what that will do is that will stimulate, we think, globally demand. The stimulation of demand does take time. It won't happen overnight, but we certainly think through the rest of 2015 we will start to see global demand for oil and oil products start to improve, and improve quite significantly, certainly more than we've seen in the last 2 or 3 years. And yet we've seen the oil price collapse to a very low level at the moment. And that's certainly going to be, we think, the stimulus to push demand higher through the rest of this year.
We were talking about OPEC in November of last year. No surprise really that they decided to keep their output targets unchanged. But if we do hit some of those bottoms that we're talking about, would you expect some sort of commentary, some sort of action as far as OPEC goes?
We don't expect anything from OPEC, and particularly Saudi Arabia. They've made their stance very, very clear. They're not going to cut production unilaterally. And the lower the prices fall, the other producers will be desperate to keep exports high to just not maintain, but just to keep some revenues flowing in. And that's the problem Saudi Arabia has. It wants everybody else to participate in the cuts. But unlike the GCC countries, the others just simply don't have the revenues or the foreign exchange reserves to keep them going. So we're not expecting anything from OPEC, at least in the first quarter of the year.
Mark, how do you see the situation panning out? Would you expect to see anything from OPEC in terms of commentary or action? Or like Amrita, would you say that, they've pretty much made their stance clear, so you're not expecting anything from them?
We don't expect anything from OPEC, no. They've been particularly clear, specifically the Saudi oil minister, in their intention. And it's very much up to the markets to regulate themselves. And that, from the OPEC perspective, is really the most sensible thing for them to do. The only, perhaps to sort of go back and address as to whether it's a good strategy, I mean, it's certainly one of the only options, but some risks in it relate to things like, with specifically shale oil extraction, which is specifically the area that they're perhaps looking to rein in because that's grown so much recently, is as oil prices fall, certainly to the magnitude that they have so far, so the extraction costs of shale oil decrease. So many people talk about this $65 level, which was a number that was talked about quite frequently when oil was at $100 a barrel. And that has, of course, moved now. And until people start to recalibrate and re-quantify this, we won't really get a precise indication on where these supposed floors are. So that's certainly one additional thing to look at. And of course, with prices having fallen so much at the front of the curve, which has invoked some reaction of other OPEC members that have voiced some concern. The thing is which bit of the curve are shale producers looking at? Because long-term oil prices are still significantly more elevated than near-term oil prices. And when you do your capital expenditure, your budgets, your drilling profiles, and so on, you're looking at hedging production out 2 years from here. So it's which bit of the curve needs to get to the level, and what is the new level considering that your extraction costs have come lower? But to answer your question, we expect nothing, certainly from Saudi. And it's really up to the markets at this point to rebalance themselves.
David, would you agree that while it may be a good strategy to hear some sort of commentary from the OPEC, they're not really going to get involved at this point? They made their stance clear. But in terms of other macroeconomic data, geopolitical concerns at this point, what are the key pockets of concern, according to you, which could have an impact on prices?
Oh, look, there's no doubt that OPEC have, as your guests have suggested already, that they're watching the markets very closely, but at this point they're not going to take any action to rein in their own production. We do, however, think that as the year does expand further out, that we will start to see some action from OPEC to actually rein in their own production. We know that they are very low producers, so that does put them on the very low end of the cost curves. However, it's unfortunate the layer of spending of the revenues that they have been generating in previous years that is really the concern. And we think that it's going to be difficult for them to rein in that revenue expenditure. So it does mean that they are probably going to have to look at raising their revenues through lowering oil production. So we do think that they will be taking those steps probably certainly by the second quarter of 2015, and we would expect by the third quarter that we would see lower OPEC production.
Okay, I have time for one last question, and Mark, I want to come to you. While the year has definitely been all about crude and the way crude prices have panned out, gold, that's the asset class that's also been in focus pretty much all of 2014. In terms of an outlook for 2015, is there something you can share with us?
Certainly, yes. That in our view is heading lower, most definitely, and any strength in the gold market should be viewed, in our opinion, as a selling opportunity, either to go short or to get out of any existing length. And certainly our framework that's guided our views for the last 2 years lower has been one of the rising rate, rising dollar policy normalization view out of the United States predominantly. But certainly the absence of physical buying, something that many market participants clung on to last year in the hope that that might cause some sort of bounce, has been absent. And inflationary pressures have been absent. And now with the oil price roughly 50% lower than where we were previously, inflationary concerns are reduced even further. So there's very little demand or very little avenues for fresh demand that we can see for gold. And its behavior as a safe haven asset has been lackluster and disappointing for the last year. Last year we had many different events that could have allowed gold to demonstrate a more interesting return profile in response to those, and it didn't. So we see that going lower down to, we will probably break $1,000 conclusively this year, and we have a target of around just above that, I think $1,025 for the average price of 2015.